Good day. So, we will continue with the module 4. We are starting the module 4 today. It is valuation of equity shares. This is part of the course security analysis and portfolio management. So, we will have 5 lectures in this particular module, and the first lecture would be on balance sheet valuation. So, the major topics which we would be covering in this particular lecture is the need for having equity valuation, what are the different valuation methods which is available, and what do you mean by balance sheet valuation. And in order to go in for the balance sheet valuation, we will be looking at the components of balance sheet, how adjustment of balance sheet valuation can be done, and the strength and weaknesses. So, this is in a nutshell that we would be discussing in this particular lecture. So, as I told you, first let us know why equity valuation is important. Who are the major parties to whom equity shares are important? Major parties are investors, second is the companies, and the third is the analysts, financial analysts who give advices to others. So, to the investors, what is the need for doing equity valuation? So, by means of doing valuation of equity, the investors would be having an idea as to what should be the price at which the stock has to be either bought or sold. So, with the information available in the financial statements, we can very well identify whether the stocks has to be purchased at a particular price, or whether it has to be sold at a particular price, or it has to be held for some time before selling it or buying it. So, this is one set of information which you can get as an investor. Second is the companies use equity valuation. For the purpose for which companies are going to use equity valuation is under different circumstances. One of the circumstances could be either merger, it could also be an acquisition, or it could be a condition where the company needs more finances and they want to raise capital from the market. So, in a way you are trying to evaluate the actual value of your firm at a point of time when you want to go to the market either for merger or for acquisition or for new issue of shares. It could be in the form of equity shares or preference shares. So, this is the second condition or second party who is going to use equity valuation. The third party is the financial analyst. They are otherwise the advisors. They could be the advisors for investors, or they could be advisors for the company as well. So, what do? They actually try to find out what is the accurate value of your firm, so that you can identify the price at which it can be offered to the public, or it could be purchased from the public, so that an investment recommendation could be given. So, I told you the role of a financial analyst is twofold. One is for the investors, where they do the accurate valuation and they say that the market price, whatever is shown for a particular company, whether it is overvalued or undervalued, accordingly they would be suggesting that it is the best time for you to either buy or sell the share. And the second condition is for the companies. They do the valuation, and the analyst would tell the companies that this is the right time for you to go in for either a subsequent public offer, or raise more capital from the market, or if you are thinking about going in for either an acquisition or selling of your company or merger of your company, what is the proportion of shares against which you can purchase it. So, you can do it only once you know the value of it. So, there are many examples of it where the mergers have taken place, and for every 10 shares of a particular company, you would be giving the 1 share of the parent company, which is going to either purchase it or merge with it. So, these are different proportions which is identified, and it is normally done by a financial analyst for company's purpose. What are the different valuation methods which you have? The first valuation method is the balance sheet based valuation. So, in balance sheet based valuation, what is happening? So, your balance sheet is talking about the assets and liabilities of the company, and whatever the assets the company is having, it would be mentioned in the at the book value. So, book value, as I told you in my earlier lecture, it talks about, let us assume that you have a machinery, and this machinery was purchased at 1 lakh rupees, okay, and this and the company is following a straight line discount depreciation of 10%. So, at the end of 1 year, what will be the price of machinery? The price of machinery would be 10% less than whatever is over here, that is, it comes to 99,000, right. So, this is how the book value is being done, but under normal circumstances, it may not be the actual value of the asset which it represents, because if suppose I have to think about a valuation method, it could be either a replacement cost which I am thinking about, or it could be either a cost at which I am going to sell it out and purchase a new machine. So, normally you find that book value is confined only to the books, but the actual value is something different. We need this book value to understand what the value of the asset is based on the life of the asset, and this could be used at the time of valuation in case of either merger or acquisition. So, we are trying to find out the book value of the assets and liabilities of all the items which is listed in the balance sheet. So, this is what is called balance sheet based valuation. The second is income statement based valuation. See, income statement is otherwise a different form of presenting the profit and loss account. So, in profit and loss account, so you should understand two basic items. One is called the revenue expenditure or revenue item, and the other one is capital item. Okay. And whenever you are preparing the book of accounts, all capital items are part of your balance sheet, right, and all revenue items are part of your income and statement or your profit and loss account. So, what is the difference between these two? It says that the revenue items are occurring frequently on day-to-day basis. So, these are representing the expenses and income which the company is generating over a period of time, but it is the frequency is more, whereas capital expenditures are those expenditures for which the benefit the company would be getting for a longer period of time. It could be more than 1 year. So, normally we prepare book of accounts every year and present it as a financial statement. So, let us keep all revenue items to be those expenses or income which you are generating in a year, and capital expenses are those which has a life of more than 1 year. It could either be an expense or it could either be a income. Based on that, it would be classified as whether it is a asset or whether it is a liability. Okay. So, now when I am coming to the income based valuation technique, So, as I told you, this talks about the day-to-day activities in terms of income and expenditure, whatever you have incurred, and this is going to give you what? It is going to give you the earnings of the company, and based on that you are trying to find out what is the company's worth. Okay. So, by using these informations, what you are trying to find out is the price earnings ratio. So, price earnings ratio, as the name suggests, what is the price you are going to pay for the share in terms of the earnings which the company is generating. So, this is what you will be doing when you are going to use income based valuation. The third type of valuation which is commonly used is cash flow based valuation. In cash flow based valuation, what we are trying to do is we are trying to find out what will be the future cash inflows which is likely to happen if suppose I purchase a particular share. Okay. And I am just trying to find the value of that particular amount which I will be getting after 1 year or 2 year or 5 year at a particular rate, expected rate. I am trying to find out its actual value as on today. Okay. So, very simple. If suppose I am expecting that I am going to earn 100 rupees after 1 year. It means to say that I am trying to find out the value of 100 rupees which I would be getting after 365 days or 1 year as on day. So, this may be equal to less than 100 rupees, it should be around 90 rupees or so. So, I am just taking an approximate value. So, it is like that. So, 90 rupees is growing to 100 rupees at the end of 1 year, or 100 rupees at the end of 1 year is equivalent to either 90 rupees today or more than that. So, it is as simple as that. So, this is what you are trying to do in the cash flow based valuation, where you are discounting the future cash flows to find the present value of that particular cash flows which is coming into the company. So, these are the 3 common techniques which is normally used in valuation. Now, let us come to what is balance sheet valuation. So, balance sheet valuation is talking about finding out the company's equity based on the balance sheet. So, how do I find out the company's equity based on balance sheet? I told you in the balance sheet you have information with regard to assets and liabilities. And I think I had already discussed about the different schedules you have in the balance sheet. So, if suppose you look at the schedule 1, it talks about share capital. The second schedule talks about reserves and surplus. Okay. And third schedule is talking about your secured loan. Fourth is unsecured loan. And fifth is your current liabilities. So, this is part of your liabilities. So, now when you come to the assets, you have fixed asset. Let me keep this as the 6th schedule, fixed asset, and this fixed asset is divided into 2 categories. One is intangible assets, the other one is tangible assets. And the 7th schedule talks about investment. So, investment which your company makes in another company, and then you have the current assets. So, in a layman's language, if you are going to look at these two, the balancing figure has to match. Okay. So, whatever is the total of your liabilities and claims will be equal to the total of your assets. So, that should be the perfect way of preparing a balance sheet, otherwise it is wrong. So, now you have a situation like this. How do I find the value of equity, company's equity, how much equity is there? So, if suppose I am going to deduct total assets, deduct total liabilities from total asset. Total liabilities, what are the total liabilities I have? So, among this, if I am going to look at things, the first two schedule is not a liability, it is the claim part which is there. So, this becomes the remaining, the third schedule onwards becomes a part of your liability. So, your total asset minus this is going to give you your share capital, okay? Or I can include even reserves and surplus, because it is that proportion which is to be shared among equity shareholders. So, if suppose I am going to include that also as liability, then I can find out what is the amount of equity shares the company has got from the public. But under normal circumstances, we do not do so. We consider the first two schedule to be part of shareholders, because this money belongs to the shareholder, reserves and surplus belong to the shareholders, and the shareholders fund could be identified by actually deducting your total liabilities from total asset, and this is called your equity value. So, this is how the valuation is done using balance sheet. And what are the conditions under which balance sheet valuation is done? It is normally undertaken in companies which are considered to be heavy industries, in which the assets whatever you have purchased is highly costly. So, such companies go in for finding out what is the balance sheet valuation, and sometimes what happens is the market prices becomes unreliable, or it could be very difficult to obtain. So, in case I own a company which is engaged in mining, okay. So, mining, the gestation period for any mining sector, I keep it as say 5 to 6 years. And if suppose I want to sell this company before 5 to 6 years, what will happen? How do I calculate the value? It becomes difficult. The reason being that there is no income generation before that, because the gestation period itself is 5 to 6 years, and there is heavy investment in terms of the assets whatever you have purchased for such sector. So, under such situations, I can use balance sheet valuation, because whatever information is available in the balance sheet could be identified as a benchmark, and based on which I can find out what should be the value of an equity share. Okay. And this is considered to be a conservative approach. Balance sheet method is considered to be a conservative approach, and it is going to give you the minimum value which you have to get from whoever is going to purchase the company, or whatever value the equity is being transferred. Okay. And under such situations, what happens is, in companies like this, you do not have any future earning potential which can be calculated, or sometimes you miss out on the intangible assets, which includes brand value and all those things are there. So, sometimes what happens is, when these things are not reflected in the balance sheet or anything of that sort, it doesn't make sense that I am going to go in for a balance sheet valuation. Reason being that even an intangible asset like copyright or a patent, all these things are assets for the company, which if suppose is not part of your balance sheet, may not be able to be valued in its true sense. Okay. So, all informations, if it is provided, then it becomes a reliable way of finding out the value of a company based on the balance sheet. If you go into the components of balance sheet, I have already told you the different schedules of the balance sheet. Let us first take a look at the asset items which are part of the balance sheet. So, assets are broadly classified into two. You have current asset and you have non-current assets. Okay. And current assets talks about those assets which has a life of 1 year or one operating cycle, whichever is less, So, it means to say that all the assets which has a life of either 1 year or one operating cycle. What do you mean by one operating cycle? One operating cycle means I have cash with me, right? In order to go in for production, I purchase raw material, I convert that into work in progress, right? Again I convert it into finished goods, and then I sell and get cash. So, this total cycle I can consider it to be one operating cycle. So, it starts from cash and ends with cash, can be considered as one operating cycle. So, anything, if suppose this is lesser than 1 year, then I am going to consider operating cycle to be the measure. If it is more than 1 year, then 1 year would be considered as the items part of current assets. So, what are the items you can have in current assets? It could be cash in hand, it could be cash in hand, cash at bank, right, or it could be cash equivalence. Equivalence here we mean short term securities, which I can sell it in the market. It could be like treasury bill or anything of that sort, which I can sell in the market and I can get money for it. The second type of current asset is inventory. The other name for inventory is nothing but stock of either your raw materials, stock of either your finished work in progress, or stock of finished goods, or a combination of all the three. So, this is part of your inventory. So, how much stock is available with you, and you know that the life is going to be either one operating cycle or less than 1 year. So, that is why we have put it over there. And then you talk about receivables. Receivables here mean the persons to whom you have sold goods, okay, but the money is not yet received. This can be categorized into two. If suppose I am going to take current assets, it can be categorized as sundry debtors and it can be categorized as bills receivable. So, what is the difference between the two? Sundry debtors are persons to whom I have sold goods and I have not taken any money from them. So, what happens is these are individuals whom I might be knowing and I do not take any guarantee from them, because in businesses it is going on trust basis. So, they become a part of sundry debtors. Sometimes new party comes to me and says that I want raw material or I want to purchase your goods. You say that I have no idea about you, I want a guarantee so that I can give you goods. So they will give you a bills receivable. So the bills receivable is nothing but the guarantee which is given by the bank who is purchasing goods from you. Okay, and if suppose they are not going to pay it on time, the bank takes the responsibility to pay you. So these two put together is called your trade debtors. Okay, so these are part of the receivables, and these are short term in nature, and they are considered as current assets. Non-current assets, as the name suggests, it is long term in nature. So long term in nature, you might have seen the 6th and 7th schedule of your balance sheet in the previous slide. So it talks about fixed asset. So fixed asset could be either as in the form of machinery, it could be in the form of land, it could be in the form of building, it could be in the form of vehicles, delivery vans or anything of that sort, right. So like that, any of these things which are highly valued, which has a life of more than 1 year, is considered to be part of fixed asset, plus all intangible assets also part of it, which is considered to be your patents, copyrights, etc., etc. So all those things would be part of it. So you have property, equipments, and the intangible assets as part of your non-current asset. Coming to the liabilities, liabilities again is classified into two categories: current liability and non-current liability. So current liability, as I have told for current asset, it is either 1 year or 1 operating cycle, whichever is lower, which you have to pay within 1 year or 1 operating cycle, is considered to be part of your current liabilities. Here you have short term debts. It could be for day to day functioning, you might have taken some loans or anything of that sort. All those debts become part of your short term current liabilities. And then payables, similar to what you had in the assets, here you call it as sundry creditors and bills payable. These two put together is called your trade creditors. So these become part of your current liabilities. Non-current liabilities is long-term debt, that is your 3rd schedule, which talks about secured loan, 4th schedule, which talks about unsecured loan. It could be in the form of fixed deposit or anything of that sort, which the company is raising from the public. And then if there is any pension obligation, all these things, these are long-term obligations which you have to maintain. So they are all part of your non-current liabilities. Apart from this, the balance sheet has information about the equity. So equity, it's very simple. As we saw, what is the accounting equation? If I am saying accounting equation is nothing but your current asset less current liability is going to give you your equity. So this is what you call as accounting equation, and that is what is meant by the shareholders owning, how much money the shareholders have put into the company. All these are represented. So now you should understand why I told you that the assets and liabilities will have the balancing figure as same. The reason being that whatever long term liabilities I have, it would be reflected in whatever long term assets. So long term liability will be reflected in long term asset, and short term liability would be reflected in short term assets. So this is how things work in business, and that is why we have two set of capital. One is for long term and the other one is for short term purposes, and all these informations would be available in the balance sheet. What are the different adjustments we normally do in balance sheet valuation? First is asset revaluation. Why asset revaluation is required? Because I told you book value is different and the actual value would be different. So, what we are trying to do is we are trying to find out what should be the value which is approximately equal to the current market price. So, in order to do that, we are trying to go in for the book value. The reason why this is required, the revaluation is required, is because you are using historical accounting, right, historical basis of accounting. This means the price whatever at which you have purchased, might be 10 years down the line you might have purchased, the price, that price is recorded, but the price as on day would be different from that particular price. So, that is the reason why you require a revaluation of assets. The next is depreciation adjustment. So, why is this required? Because whenever you purchase any asset or machinery, they say that the life of this asset is going to be 10 years. So, accordingly, I decide the depreciation, how much depreciation has to be charged on the fixed asset. Okay. So, you have different methods of charging depreciation. You have written down value method, you have a straight line method. So, that is left to the company. So, that is the adjustment which you would be doing in terms of depreciation. Then you have intangible asset. Intangible asset, sometimes it is not possible for us to give a numerical value or monetary value for intellectual property or brand value, right, but still we are trying to convert that into monetary terms. That is reflected over there, and for that also we require certain adjustments to be done. The best example which we can take is in terms of goodwill. So, whenever the company is sold, I am going to get something more than what the asset the company holds. That excess amount is what I am calling as the goodwill. For the period I have been in the market, the name I have generated in the market, that also carries a value. So, that is also, that has to be reflected and that has to be adjusted in the intangible assets. And then you have debt adjustment. Debt adjustment is required because if suppose, let us assume that you have borrowed some money from the market and you are calculating cost at the historical rate, but the current market rate might be different. This becomes important or significant in case of forex transactions. If suppose I have borrowed from US at 10% rate of interest, and now the value of the currency has changed. In such cases, what will happen? The amount of repayment will change because of either appreciation or depreciation of the currencies. So, this adjustments has to be brought about in the balance sheet. So, what is the impact of these adjustments, whatever you have done in the earlier slide? It will help you to calculate the value of equity, which is in alignment with the market, right. So, this is the reason why adjustments has to be done in balance sheet, so that it gives a realistic picture and find out the value of equity. What are the strengths and limitations of balance sheet evaluation? Balance sheet evaluation strength is, it is simple because it is very straightforward. You have only 4 categories of items, that is either current or non-current items in liabilities or assets. So, it becomes easier for you to calculate, and almost all the information is available and it is easy to understand. So, simplicity is one of the important thing. Next is, it is considered to be conservative. Conservative, why? Because we are considering the minimum value. Even if suppose I have enough stock, the inventory whatever I am going to hold, if I am having enough stock, I will be recording it at the minimum value, which could be either the market value or the actual cost whichever I have incurred. So, why we do this? Under worst scenarios, we do not end up in a loss. So, that is what you mean by the conservative valuation, and this is again useful for asset heavy firms, as I told you, mining sector and other things. So, under such situations, the balance sheet valuation can be considered as a good type of valuation to find out the value of an equity. The limitation, it does not take into consideration the future earnings, because here no earnings, I am not considered any revenue item, we have only considered the capital part. As I told you, we have capital and revenue, and we are considering only the capital part. So, the future earnings is part of your revenue item and it is not considered. So, that is one of the limitation. Intangibles are often missing. So, sometimes we are not able to convert brand value or customer loyalty into monetary terms, and this could be one of the major drawback in terms of valuation of a particular company. And the market value is going to be different. So, I told you, you are recording it at historical cost, but the market for cost would be different, and this is quite obvious in situations where you are going to own large physical assets. What are the conditions where balance sheet valuation has to be used? As I told you in the previous slide, if it is a asset heavy company or if it is a stable company. And in case if it is a high growth company or a tech industry, we can go in for the other type of valuation whichever is available. So, that is the thing. So, in this particular lecture, I have tried to give you the meaning of valuation, why valuation is necessary to be done, and what are the different types of valuations available, and within that I have just touched upon the balance sheet valuation and the various adjustments which we do in the balance sheets. Thank you.